name is David. I'm a mortgage broker and I do everything home loans, residential, commercial, multifamily. And I'm sure you guys have a lender that you work with already. Most great realtors do. So I just want to give you guys some information that I think is always helpful for customers, for realtors. We'll make it quick, and if you have any questions, you can pick my brain and we'll move on with the day. That's my number. I am originally from Los Angeles, and that's our company. It's actually LAMC, but that's what it stands for, Los Angeles Mortgage Company. And yeah, that's my cell phone. If I'm always trying to be available for you guys, for the customers, for you guys, because sometimes real estate happens after 5, after 6, or even on the weekend, because our customers are making that money to pay their house, right, in those investments. Can we go on to the next one, please? So I'm going to talk about 4 quick points. We'll talk about the pre-approval pillars, the documentation needed, and the escrow process. Finally, the loan products that we have to offer. So let's talk about the pillars. The pre-approval pillars, guys, this is gonna be the same thing that every lender looks at, whether it's me or broker Joe down the street or maybe someone at Rio Bank. Every lender looks at the exact same thing. So you guys can almost become a loan expert and consult with the customer with these 3 questions. We look at the credit, we look at the income, and finally the assets. It could be multiple bank accounts, it could be a property that the customer has, it could be a 401k, they could be selling a car to get the money, whatever the case may be. As long as it's documented and it's not like $100 bills, we can use the money, right? So let's talk about credit real quick. Credit, we'll stay on that screen for just a second. Credit, most banks want you to have a 620 or above of a credit score. I always like to tell the customers, try to be at 700. Why? Because it avoids that extra layer of underwriting, and the underwriter already knows that you pay everything on time and that you're also responsible with your credit. They're gonna give you hundreds of thousands of dollars at the end of the day, so they wanna know you're paying back that money, right? We've done loans as low as 580 for FHA borrowers. So there is that one consumer that's a first-time home buyer, they've never really dealt with their credit, maybe had a repossession 7 months ago, and they have bad credit scores, but they have everything else paid off. So it takes time for the credit to go up, sometimes 30 days, 60 days, or 90 days, because the credit bureaus don't report every week. They usually report once a month. Capital One reports every 45 days. It just depends on the company and the account. So we also do what's called a rapid rescore. Have you guys heard of a rapid rescore?
Rapid rescore.
Okay. Basically, it means that, let's say a borrower comes to us and says, I want to buy this house, but everything you see on my credit report has already been paid off except for the cars. So I ask for documentation, they give me proof, we send it to Equifax, Experian, TransUnion, and they update the credit report within 5 to 6 days with that documentation. And then you get a new credit score, and that tells us how much your new score is gonna be, and we can use that for underwriting purposes, or even to go shopping, lock the rate, whatever the case may be. That's a rapid rescore. So sometimes a low credit score scares loan officers or realtors. Let's take a look at their history and just have a conversation with the consumer, and they'll be able to tell us if they paid stuff down, if they haven't. Now that does cost money, like $90 per account, because TransUnion charges $30, Equifax charges $30, and Experian charges $30. So somebody has to pay for that. Sometimes you absorb the cost if it's a really, really good customer or a past customer, and if not, then we just tell the consumer, hey, this is the cost, but we're gonna give you like 6% versus the 7.3 or whatever, and it always makes a big difference, right? Income piece, where any bank is gonna qualify you with 2 years of income. We have bank statement programs where you can use that to qualify with 1 year of bank statements, and you don't file taxes. The down payment is 20%. We also have obviously the standard traditional Fannie Mae and Freddie Mac way, which is 2 years of tax returns. We only use federal tax returns, so great thing in Texas is we only have federal tax returns. And I mention that because we do lend in all 50 states. So if you guys have a customer in Nevada or in another state, don't lose the business. Try to retain that business, and at least you'll still get some compensation from the loan side, right? And then the asset piece, this is all gonna depend on the type of loan that they're getting. If you have a customer that's buying a house with an FHA loan, your minimum down payment is 3.5%. So the easiest explanation is, Mr. Borrower, every $100,000 that we lend you, you're gonna have to come up with 3.5%, which is $3,500. And if you're a first-time home buyer, there are some programs that are down payment assistance products. I tend to shy away from those because those customers usually are looking for freebies. Not all the time, but if they're not responding with documentation, if they're not responding with helping you get what you need for your pre-approval or to go home shopping, then it's important to let them know that it is a little bit of a lengthier process because they have to go through home ownership education courses, which is 8 to 16 hours online. They have to pay for that. And in addition, your debt to income ratios are lower for down payment assistance products. What does that mean? It just means that, let's say if you qualify for $250, now you're gonna qualify for $230, right? So that's a little bit about the asset piece. And then the final thing I wanna mention about that is, if you're buying an investment property, you do need 6 months of reserves for that mortgage payment. So the mortgage payment is $1,000. Just make sure they have $6,000 in the bank, right? You can use 401ks, you can use savings, you can use whatever the case may be to show those funds. Documentation. So if you're going with a traditional loan is gonna ask for your ID, your social security card, your pay stubs for 1 month, W-2s and tax returns, or 1099s if they're self-employed for 2 years, and then finally your bank statements for the last 2 months, all pages. As a lender, we always need all pages, even if the last page says intentionally left blank. Sometimes the banks do that, but our underwriters always ask for it. So we always ask for all the paperwork. Like I mentioned, we also do bank statement loans. So if a customer has a high cash flow, but they just write everything off, that's okay. We'll use the bank statement to qualify them. Their interest rate might be 0.5% higher, but they can still get the loan. And they're saving money by even paying a higher rate and not paying income tax when they file those $100,000 or $200,000 in income. Right, so it's a little bit of a mortgage trick, if you will. All right, let's talk about a month in escrow. Now, guys, like I said, everyone seems pretty seasoned, pretty knowledgeable here, so if I'm just repeating info you guys already know, bear with me. Just part of the presentation. It doesn't mean I think you don't know this info. Standard for just getting info across. We have a 4-week process to close a loan. Most of the time, we're able to close in 3 weeks, which is like 21 days. Doesn't always happen, but if we have a really, really good team, we'll have a closing in three weeks or less, right? So your first week, you get the earnest money deposit submitted to escrow. That's after you get your offer accepted. So this is once the seller signed the contract, you're in escrow, you give your earnest money deposit. It could be whatever you put in your contract, that's your EMD. You submit and disclose a loan, that's on our side. We send the loan off our desk and send it to underwriting. By this time, we already chose a bank, right? My job is to make sure I find the best bank with the best interest rate and loan product for the customer. As a broker, we Rolodex through different banks, such as UWM, NewFi, Loan Stream. It could just depend on what product you're looking for. UWM is really, really, really good for FHA and conventional loans. NewFi is another bank that's a top lender for non-QM loans. Have you guys heard of non-QM loans? Okay, non-QM loans are loans that are not traditional loans like FHA or conventional. They qualify you with bank statements or DSCR, which is your debt service ratio. You can buy a house with 20% down, and just like the bank statement program, you don't need to show any documentation of income. You can qualify with the rental income of the units or the single family residence. So that's another way to just use your credit, the income of the property, and then your down payment. 20% down will get you 1 to 4 units, and you can use a cash flow to qualify. And then even if you owe Uncle Sam or haven't done your tax returns, you can still qualify for a purchase. That's a DSCR loan. So The first week, going back to our process, we submit and disclose the loan. Disclosures means it's a loan estimate that we give, your initial loan estimate, right? We want to tell the customer what they're going to pay, where all these monies are going to. As a loan officer, we really only control the origination fee and we help out with the interest rate. At the end of the day, the interest rate is what the market gives, right? We order the appraisal and then we lock the interest rate for the customer. Locking the rate is super important because it's not something we can do every week. It's just a one-time thing, and if rates go up or down, they're locked in at that rate. Now, if interest rates go down significantly, we can always just find a different lender and get them that better interest rate. It hardly happens, maybe once every 4 or 6 years, but when that happens, we're prepared. Week 2, we usually get your loan approval back with conditions. Conditions means like, let's say the underwriter wants to get another pay stub from the consumer, or maybe a verification of a mortgage, or a recent bank statement. These are all simple documentation. This is all simple documentation that we ask for just to proceed with the loan and make sure we get to the closing table. Another condition could be maybe the appraisal has to be returned, or the underwriter wants to see the inspection report because there's too much damage in the property. So these are small examples. We also get your appraisal back confirming the value and the condition. Most appraisals are as is, but some conditions that I've seen on appraisals when you do FHA loans for first-time home buyers, they don't want to see any chip paint on the eaves, water heater has to be double strapped, they want smoke detectors in every room, carbon monoxide detector in the house, just one, and they want the roof to be in a good condition. Doesn't have to be new, just a good condition. Week 3, we're gonna get your closing disclosure out. These are the final figures for the transaction. So your closing disclosure means your fees cannot change after that's triggered. You get your closing disclosure issued, you sign it, and this is what replaced the famous truth in lending disclosure back in the day. I'm not sure if any of you remember that piece, but the closing disclosure is your final document for fees. You sign it, and you cannot sign loan docs until 3 business days go by. Okay? Why do they do this? It's a cool-off period to make sure the consumer knows what they're signing, they understand, and if they want to cancel, they can. So 3-day cool-off period, you sign the closing disclosure, your conditions are reviewed by the underwriter, and then you get what's called a clear to close. A clear to close means you're out of underwriting, you're done with the paperwork, you're done with the back and forth. Now it's just working on your loan documents for the consumer, right? So I want to remind everyone that an underwriter is not a brick wall, they're just a person. So sometimes paperwork comes in a little bit messy and we just have to explain the story and say, you know, Mr. Underwriter, there's 3 businesses and 2 of them deposit here and another one here, and that's why there's a bunch of funds being moved around. But if we explain a story to the underwriter, they'll understand what's going on. Their job is to help us get to closing and to catch anything that's ineligible, right? And then finally, week 4, we get your loan documents issued and signed with the notary. Usually we go meet at title and have them sign there. We have mobile notaries on standby anyway, so if it's after hours, if it's the weekend, we'll still get it done. Our goal is to sign loan documents the same day that they're issued so that we don't waste no time, we get the loan to closing, and everybody gets paid. We send the final funds the same day that the customer signs. Usually we have them take a cashier check to escrow, or I take my computer and have them send a wire from their account to title's account that same day of signing, so no time is wasted. We work on the loan funding and recording, same day. So typically, when you sign, you give the money, you close. It's a quick process, right? It all happens the same day. So that's week 4. Typically, we're seeing about a 21-day turnaround time right now. So there's a statistic I want to share. I think that this is a little incorrect, but it's a NAR statistic. They say about 38% of your average income goes to housing. I think it's just more towards like 45 to 50%. Why? Because people have to pay for maintenance, utilities, wear and tear on the property. Sometimes there's issues after 5 or 10 years with the home. You have to replace the roof, or you have to replace the the piping or whatever. So they're saying that on average, 38% of your income is gonna go to housing, right? So sometimes we qualify consumers for a property, and the bank allows us to use up to 45% and in some case 50% of their income to qualify them. So the easiest explanation is you take their income, you multiply it by 45%, and that's the mortgage payment they're gonna qualify for. So if they make $10,000 a month, they can qualify for a $4,500 mortgage payment, right? So that's a little bit about debt to income ratios and how banks qualify customers. We don't typically use the monthly income, we use an average of the income. That's why the bank statement program asks for 12 months. Maybe one month you got more deposits than other months, and that's why you average out your income, right?
Cool.
Let's talk about the products real quick. So good stuff. So, do y'all deal more with investors or first-time home buyers here? All of the above?
Both.
A little bit of everything? Okay, cool. Your FHA loan allows us to qualify someone with as little as 500 FICO score. Now that's called a manual underwrite. Basically means that the system automatically doesn't approve you for a home loan. Somebody has to go in there and make sure that you qualify. This is an underwriter that goes in there and they see your income, they see your debt, and they approve you for a home loan. If you have a 620 or more, you can qualify with a DU approval or an LP approval. It's the same thing, just soda and pop basically. Fannie Mae gives DU approvals and Freddie Mac gives LP approvals. So those are the two housing agencies that make up the lending rules in the nation. We also have a 3.5% down payment or down payment assistance if you're a first-time home buyer for FHA loans. And then you have something called mortgage insurance. So in your total payment, your PITI, we have to also include mortgage insurance for FHA loans. And then moving on, for the more experienced home buyer or someone who has a larger down payment, we can qualify them with a 3% down and above. Usually these consumers give a larger down payment. Mortgage insurance is based on the credit and down payment. Once you get to 20% down payment on a conventional loan, there's no mortgage insurance. They're just PITI, your principal, interest, taxes, and insurance, right? And the investor product. This is my favorite type of loan because these consumers usually move a lot faster. They know what they want, they've been through the process before, they just wanna get the property, get the mortgage, and move on. So DSCR allows a 20% of a down payment, and we don't ask for any documentation. The appraisal will give us the rental income, and that qualifies the income in general. So all you need is credit and down payment. The income is based on the property. That's called DSCR. With a 20% down payment, you can buy 1 to 4 units and don't even show your tax returns. The second thing is we do a program, or we offer a product that's a fix and flip 10% down loan, where we will lend the customer the money to fix the house. So they only come in with 10%. Let's say they find a project at like 150,000. So you get 15% down and we'll lend you whatever you need, 30 or 40,000 to fix the home. These are 6 months to a year loans, so they are private money or hard money. Same thing, same difference. And we always have to have an escape plan or a exit strategy is what they call them, right? So you want to know, Mr. Buyer, are you going to refinance the house? Are you going to fix and flip the house? Is your goal to keep it long term? Just find out what they want to do so that in the end we have that decision of what they're going to do. But this fix and flip product doesn't only qualify the borrower, but it also qualifies the property. You can't buy a fix and flip at what the market is already offering properties at in that area. And what I mean basically is you have to get them at a discount. So if we find properties at a discount, we can finance the home with 10% down. If you're buying the property at a value as if it was already repaired, then that just means the seller's trying to get a good deal on a property that's not worth what he thinks it's worth, right? Hard money and commercial loans, they're at 30% down. Typically there's no credit check. We look at the project, the cash flow, and the customer experience. If the customer's built a couple houses before, we can lend to them. If they haven't done any projects, any fix and flips, then we're gonna investigate a little bit more, maybe ask for more documentation. If the homes aren't under their name and they've been part of projects, I deal with a lot of contractors, we could still use that as a project of experience. We just have to put it in a worksheet and give 3 different projects that they've worked at in the last 3 years. And new construction with 20% of the project. So we can help consumers buy lots and build their dream home with 20% down. And we finance the construction of the project as well. This is actually a bank that we deal with out of Austin. And they help us do new construction. This is different from houses that are new that are already listed for sale. You have to go find the lot in this case, get your contractor, get your architect, and then we can finance this purchase, right? 20% down, and in some cases, if you have experience, we can do 15% down and help you build your home. Now, a lot of customers get these products, and if they decide in 6 months or a year to live in the house, that's on them, right? We issue the program as an investor product. So as long as they have an exit strategy and they're conscious that your loan is going to be due in 6 months or a year, whatever the terms we choose are, then that's totally okay. It's up to the consumer to decide that, right?
For new construction, I'm assuming that's 20% loan to value? Or
Yes.
Loan to cost, sorry.
Loan to cost.
Gotcha.
Exactly right, yeah.
Okay, and you guys finance the land as well? If they're
We do.
experienced?
I used to have customers come to me with a lot already purchased.
That's what we normally do. We already have a lot, paid in full.
Mm-hmm.
So if that's the case, are you able to take the lot into consideration for its value and potentially cash out?
Yes.
Yeah.
I would rather not have the customer buy the lot because let's say a lot is worth like $90,000, they'll have to buy that cash, right?
Sure.
But if the whole project is just a little under 90, we'll finance the lot purchase and the construction. So it does save you money,
Sure.
right? Now these interest rates are a little higher. Like I said, they're private money, hard money, so they're set to be short term, 6 months, 1 year, and in this case they start at 11% interest only. Pretty competitive is what the market is.
11% based on whatever it is that you're drawing.
11, yes, that's another great question. So,
They call it Dutch or whatever you want, right?
yeah, your Dutch,
Yeah.
that's right, your Dutch product. So, what you're talking about is basically, you don't start paying your mortgage payment on the loan that you closed on until you start borrowing the money, right? So let's say the lot costs $90,000, you'll start paying your principal and interest on the $90,000. Then once you start cashing out another 30 grand for another phase or 100,000, whatever you cash out, then you start paying on that amount that you borrow. The amount that you request from the bank is gonna be set in an escrow account until you cross that bridge and get that money, and then you start paying on those monies. If you don't use all the funds, then you don't pay your full mortgage payment like we proposed at closing. That's a very good point.
Right. So I know it varies, right, depending on what lender you go with or how strong your applicant is. But more or less, because I know you're a broker, what is it that you guys charge as far as loan origination and what are the fees, I guess, like processing fees, appraisal and stuff like that? What does that look like?
That's a good question. We usually charge 2% in origination. And
Aside from whatever, or that's 2% total.
2% total, including
Gotcha.
the broker's fees and the bank's fees.
Gotcha.
Yeah, we try not to go above 3%, and 2% is still very competitive. Most lenders charge 3 and 4%, so we just charge 2% total. That includes our origination fee, the bank's origination fee, and they charge about another $1,500 to process and underwrite the loan.
Cool.
Yeah.
So that's it, just 1,500, because I know sometimes there's underwriting fee, legal fee, processing fee, and all
Garbage
sorts of
fees,
fees. Yeah, garbage fees, and it's like 5 or 6 grand and just a bunch
Yeah.
of fees. We've dealt with that from a lender actually out of California, Carlo Capital. I don't know if
Okay.
you've heard of them.
I've heard of the bank, yeah.
Yeah, Carlo. We've done a lot of projects with them, and 2 new construction projects, and yeah, they nickel and dime me on those garbage fees.
I get it, man.
That-
Yeah. We try to stay competitive because there's so many lenders out there, and like I mentioned, typically I see a 3% origination fee altogether, and that's pretty expensive, you know, considering the loan amount that you're borrowing against. Yeah. So 2% origination fee and about $1,500 for underwriting and processing. Everything else, quite frankly, guys, is going to be garbage fees. So if you see those on your sheets, try to negotiate, talk to the lender. They're people, not a brick wall. So try to figure that piece out. Yeah. All right. My processor is a gentleman named Felipe Garcia. I try to focus on origination and attending the customers, because sometimes if we're not available, they will find somebody else, right? So my job is to just be available for you guys, pre-approve customers, make sure we answer the quotes that are coming in, and then once the loan is in escrow, I work with my processor Felipe, and we make sure that the loan is always attended to from like 8 in the morning till 6 in the afternoon, and after hours, the line goes to me directly. So if you guys have any loan questions, you can always reach out to me. And then once the loan is in escrow, you will be hearing from the processing team. It doesn't mean that I'm not involved. It just means that the loan is being worked on while we're in appointments, attending customers, prospecting, whatever the case may be. What questions do you guys have for me? Pretty straightforward, huh? Yeah. Cool. I appreciate you guys letting me come in and talk to you guys a little bit about what we do. Hopefully I'll be able to help you guys with future customers. Like I said, we're always available, even if it's after hours and weekends. We know the customers are making the money to pay for the projects, and a lot of them are business owners. So if you need any help, I'll be dropping off my number here, and I look forward to helping you guys out and working with you.
Cool.
I have a question.
Yeah.
What do terms look like for somebody that's using more so of like a bank statement loan as opposed to like a traditional, 2 years of employment and check stubs and all that good stuff?
Your fees are the same. Your interest rate is going to be higher.
Correct. Yeah. So that's like how much higher?
Like 1%.
1% higher.
Yeah. As low as 0.5% and as high as 1.5%.
Okay.
So if rates right now are like 6, you're looking at 7.3, maybe 7.
Okay.
Yeah. And if they have a really, really good score, it's just going to be less than that. Yeah.
And it's strictly like bank statements, or how does it work? Like,
You can use bank statements. And these are interest rates that are fixed for 30 years. So it's like a long traditional mortgage, and it's, in my opinion, better than hard money because you're already paying in the principal. It's not just interest only for 1 year. So you use bank statements for the cash flow, and just bank statements. Yeah. We don't use any tax returns, any W-2s, no 1099s. So
you can close that as fast as, for instance, closing like fix and flip loan, or is it
Same
take
thing.
a little longer?
Yeah, same thing. Yeah, those are, some banks close like in 10, 11 days, so they're really quick.
Got you. And hypothetically speaking, if somebody wanted to use it for like, I don't know, to flip a property or to flip a house, and their personal financials are in order and they're able to utilize like a bank statement loan to secure financing for a fix and flip, do you guys get penalized in any way as far as being the lender if I buy the property, fix it up, and sell it in like 3-4 months?
There's no repercussion.
For you guys, because I know, like I've heard, I don't know how true this is, but for like other lenders, like CMG, a lender told me that they have to hold on to the property for like 7 months. If not, they bill them back or something like that. I don't know how true that is, right?
That is 100% true, and even some lenders on even conventional loans, if you pay off the mortgage in 6 months, they'll charge the commission back to the loan officer.
Yeah, that's what I was gonna say.
Yeah.
But in your case, you don't have to worry about any of that?
There are no repercussions, no.
Cool.
Yeah. Typically, we warehouse the loans, and the bank sells them in a warehouse line, and their servicing is gonna change.
Right.
So that's just the only difference.
Yeah.
Yeah,
That's
but
how it
the
always
template-
happens, right? Like they'll sell it to like Penny Mag or
That's right,
Mr.
yeah.
Cooper or whatnot. Yeah.
Yeah, that's right. Yeah.
Cool.
Yeah, I was gonna ask how fast were those loans gonna be closed, like the fix and flip ones and stuff, and for consideration on that, like you underwrite the property and see like what the after repair value is gonna be in order to see if it makes sense for that.
Yeah. Typically, I'm gonna ask you for like the address, what's the property's purchase price, how much you're gonna put into it, and the after repair value, the ARV, And with those items, I can give you a quote.
Okay.
And I'll be able to tell you, well, we think it's worth this, or you're right on the money and that's what it's worth. And with the property address and the info, we can get you a quote like within 10 minutes.
And then how much does like the person's financial, stuff take into account on those loans?
I would recommend just having a really, really good credit score
Mm-hmm.
and an LLC.
Okay.
And that way you close in the LLC, you have a good credit score, and that's all we need. They don't even ask for asset documentation for these fix and flip products, so we don't want bank statements. They're not needed. It's a quicker process, and that's why they close a lot faster. More than anything, it's just like your appraisal, making sure the borrower has their paperwork in order, and you can close. Yeah, so they're really, really fast. Those are really good products. They're for investors, like I mentioned, but I've had customers buy with 10% down. In the future, they refinance and they live in the home, right? So as long as they have a good exit strategy, this is primarily for investors to use that product.
Yeah.
Yeah.
Cool.
Cool.
Thanks, guys. Yeah.
Do you have a card?
Yeah.
Yeah. Of course. Excuse me.
So, I mean, you guys don't just do land, right? It's only homes and houses and stuff like that.
We do land as well. Typically, land is 50% down, and then we're gonna build on it, and then I can get you the 20% down product and so on.
Mm-hmm.